Say good afternoon and welcome to the 2026 Small Business Forum. We are thrilled to welcome you here today. For those of you here at headquarters in DC, welcome, and for those of you joining us online. But before we dive into some of these topics that are kind of driving the issues in small business capital raising, I want to note on my behalf and on behalf of the commissioners and SEC staff here that the views expressed today are our own. In my case, in my capacity as Deputy Director of the Office of the Advocate for Small Business Capital Formation, and they don't necessarily reflect the views of the Commission, the commissioners, or any of our colleagues on the staff. So with that covered, it is my pleasure to kick things off by inviting Chairman Atkins to the stage to share some thoughts, and then he'll be followed by Commissioner Peirce and then Commissioner Ueda. Chairman Atkins?
Thank you very much, Amy, and good afternoon, ladies and gentlemen, and welcome to the SEC's 45th Annual Small Business Forum. So warm greetings as well to those of you who are joining us by live stream. And of course, my sincere thanks to the Office of the Advocate for Small Business Capital Formation for organizing today's program and for its steadfast advocacy on behalf of American entrepreneurs. Let me also add the customary disclaimer, which Amy just said, so I'll just put it very briefly that these thoughts are my own as chairman and not necessarily those of the SEC as an institution or of the other commissioners. So for 4.5 decades, this gathering has grown to become one of our most anticipated events, perhaps because it's rooted in the premise that those who write the rules have an obligation to hear from those who operate under them. So to all of you and all the entrepreneurs here today, thank you for deepening our understanding with your experience and for enhancing our rulemaking with your recommendations. Although today marks my first forum as chairman, I attended several of these fora as commissioner in the aughts when we convened across the country. And there is something bracing about meeting small businesses in their own communities. As we look ahead, I would welcome the opportunity to bring this program back on the road. After all, as capital formation rarely originates in Washington, so we should look beyond the city limits on how best to facilitate it. For now, though, we have a terrific program ahead of us, organized around 3 different panels that I think reflect real friction points in our current regulatory framework. So let me say a brief word about each of them. Our first panel will focus on how we can better support early-stage entrepreneurs in accessing capital. For context, the Commission last reviewed the exempt offering framework in 2020 when it adopted rule changes intended to open those pathways to small business. That framework continues to function well for relatively larger offerings, yet 84% of early-stage businesses struggled to secure capital last year. Access to affordable capital clearly remains a challenge for entrepreneurs, and I've instructed the Commission staff to explore solutions to these barriers that these businesses face so that our rules work as much for the established as for the aspiring. Our second panel will then turn to the role that smaller funds play in supporting growth stage companies. 2 pieces of proposed legislation in Congress, the House's INVEST Act and the Senate's Empowering Main Street in America Act, include several policies that are relevant to this space. I especially look forward to hearing our panelists' views on provisions that affect small fund managers and growth stage companies. This panel will also examine trends of increased concentration in the venture capital industry. For example, in the first 7 months of 2025, roughly 40% of all venture capital dollars flowed to just 10 companies, while the share of deals below $5 million fell to a decade low of 49%. On the fundraising side, 30 firms accounted for approximately 75% of the total venture dollars raised in 2024. Early stage investors are often the first to identify breakthrough innovation and to broaden the pipeline of emerging companies. So smaller, nimble investment firms must continue to have the opportunity to thrive across both industries and regions. And then finally, our third panel will reflect on how to make IPOs great again, especially for small cap companies. One of my highest priorities with respect to the SEC's disclosure rules is to scale the requirements with a company's size and maturity. Balancing disclosure obligations with a company's ability to bear the burdens of compliance is particularly important where Congress has directed the SEC to promulgate a disclosure rule whose costs may have disproportionate impact on some companies. For newly public companies, the SEC should consider building upon the so-called IPO on-ramp that Congress established in the Jobs Act. For example, allowing companies to remain on the on-ramp for a minimum number of years rather than forcing them off as soon as the first year after an initial offering could provide companies with greater certainty and incentivize more IPOs, especially among smaller companies. Raising capital through an IPO should not be the privilege reserved only for a few unicorns. More and more, public investments are concentrated in a handful of companies that are generally in the same one or two industries. Our regulatory framework should provide companies in all stages of their growth and from all industries with the opportunity for an IPO, particularly one that represents a capital raising mechanism for the company instead of a liquidity event for insiders. As we pursue each of these priorities, let me close by once again thanking the organizers of today's program and each of you for participating in it. I would also be remiss not to note that today marks the 250th anniversary of the publication of Adam Smith's book, Wealth of Nations. A fitting occasion, I think, to convene a forum dedicated to the proposition that free individuals, unencumbered by unnecessary regulation, can build and innovate in ways that no sovereign hand could prescribe. For 45 years, this forum has facilitated the kind of honest discussion on which positive policy outcomes depend. For 45 years, it has reminded us that durable rules are forged not through imposition, but through dialogue, and that they must be not only well-intentioned, but well-informed. So I look forward to a constructive conversation and to the work ahead of us. So thank you all very much again for your participation.
Good afternoon, and I think that reference to the Wealth of Nations is a good one because Adam Smith was someone who really delved into the details. If you read that book, he really delved into the details to draw his conclusions. And I think that's a good sort of example of what you all are going to do today is really talk about the details to help inform us and help us get to the right place so that indeed the markets can drive change and not government regulation. We want government regulation to provide the framework within which that the markets can decide where they want to go. So this is the 45th annual Small Business Forum, and I'm delighted to be part of that today. It's a wonderful opportunity to hear from a wide range of folks with a shared passion for the entrepreneurial spirit of America. Essential to our nation's prosperity is the willingness of founders and investors who fund them to take on the risk of building and growing companies. As SEC Commissioner Barbara Thomas explained 45 years ago, we at the Securities and Exchange Commission must help foster the kind of environment which will encourage people to accept rather than avoid the opportunity to take a risk in search of reward. I look forward to hearing your thoughts on how the SEC can foster that kind of environment. Today's panels, as you've heard, cover capital formation challenges across all stages of the corporate cycle. We'll hear about problems that are a universal experience, and we'll also hear about problems that are particular to a particular stage of development. Fittingly, the first panel starts at the start, funding founders. Founders' paths to raising money for their promising ideas are riddled with regulatory landmines, a source of deep dismay and consternation for well-intentioned founders. The first thing they may encounter is the much-discussed concept of accredited investor, but simply knowing what makes an investor accredited does not solve a founder's problems. Rather, it's just the beginning of a long list of questions without neat answers. Can you sell only to accredited investors? That depends. What do you need to do to make sure that your investors are accredited? That also depends. What information do you need to give to your investors? That also depends. Founders can find some help in wading through these and other questions on the SEC's website, and I urge you to check that out. The Office of Small Business Capital Formation has done a great job of pulling together some resources, which I will link in my statement here. Today's discussions could help to shape substantive steps by the SEC to make life easier for founders. Among the topics you might want to consider are a micro-offering exemption that would simplify early-stage fundraising. Under such an approach, as long as an issuer stays below a set offering amount, it would be able to sell shares of its company to investors without any strings attached, other than, of course, avoiding fraud. A regulatory structure for finders, an idea that is now under consideration by our Small Business Capital Formation Advisory Committee, also might help founders find funders. And then for the second panel, we'll be turning to the next step in a company's development, the growth stage. Business development companies, venture capital funds, and small private funds provide much-needed capital to growth stage companies, which are engines of innovation. Broadening access to these smaller funds could increase the capital available for investment in growth stage companies. Ideas for increasing capital for growth stage companies include an idea embodied in the INVEST Act, which passed the House and would amend Section 3C1 of the Investment Company Act of 1940 to enable a qualifying venture capital fund to have 500 investors and 50 million, up from 200 investors and 10 million, 250 investors and 10 million. Additional changes could include increasing the limit for issuers that are not qualifying capital venture funds and expanding the definition of qualified purchaser under the Investment Company Act. I look forward to hearing your thoughts on these and other ideas for helping growth stage companies. Today's final panel, as you've heard, will discuss the IPO process and key considerations for smaller public companies. Last year at this forum, we heard from the CFO of a smaller reporting company who explained how, with limited personnel in-house, the quarterly reporting process can be a continuous year-round activity. Moving away from mandatory quarterly reporting could allow smaller companies to more effectively allocate their time and resources, both of which are limited. More generally, the Commission's ongoing initiative to streamline Regulation SK could benefit small public companies. An important part of that initiative is listening to feedback from issuers that are already public or are considering going public. We have already heard from companies across the spectrum that executive compensation disclosures have ballooned over the years and have made it very difficult for issuers, particularly because investors show complete disinterest in much of the information that our rules require, yet that information is very difficult to compile and report. Similarly, because some disclosure obligations are based on dollar thresholds that have not been updated in years, disclosure burdens have increased over time. So, some topics for you all to think about: what disclosure obligations are the most onerous, and how could the SEC lower the burden on small public companies while still protecting investors? The Small Business Forum convenes people who care deeply about creating a healthy environment for entrepreneurship. I want to thank all of you for coming today, and I want to thank the offices and teams here at the SEC who have worked so hard to make this event possible. I'm looking very much forward to hearing your ideas for how we can improve the landscape for small businesses. Thank you.
Well, good afternoon, and welcome to this year's Small Business Forum. Each year, the forum provides an opportunity to identify areas and topics where the SEC's rulebook can be better adapted for small businesses. According to some sources, small businesses employ nearly half of the American workforce and represent 43.5% of America's GDP. They are the cornerstone of the American economy, and the Commission's rules should reflect this importance. Since the change in administration in January 2025, the Commission's regulatory priorities have been refocused on capital-raising policy recommendations, particularly for small businesses. How can we reduce the costs and burdens for small businesses seeking capital without compromising investor protection? One issue underpins many small business capital raising topics: eliminating the duplicative qualification processes between federal and state authorities. In 1997, the Commission and state securities regulators acknowledged the need for efforts by federal and state regulatory authorities to craft a more efficient division of labor with respect to securities offerings. Nearly 3 decades later, this exercise remains incomplete. This is even more important for small businesses who may be seeking only to raise a modest amount of capital, such as through a Rule 504 or a Regulation A Tier 1 offering, and might have to qualify in all 50 states plus the District of Columbia in order to use general solicitation. The costs and time delays make such efforts simply untenable. The National Securities Markets Improvement Act preempts state blue sky regulation for securities listed on a national securities exchange and also for offerings under Rule 506B under the Securities Act. The overarching aim of NSMIA was to promote efficiency and capital formation in the financial markets. With regard to duplicative state regulation, NSMIA focused on whether the potential lack of uniformity in state law impacted the cost of capital, innovation, and technological developments in the capital markets, including any impacts on small businesses. Under NSMIA, regulatory predictability was a key concern for all offerings, not merely those subject to preemption. And Congress tasked the Commission with studying the extent to which uniformity of state regulatory requirements for securities that are not covered by the NSMIA preemption provisions, which was completed in 1997. But this effort should not have been a one and done. The interplay between federal and state securities laws should be a matter of continuing study by the Commission. It is both impractical, costly, and unrealistic to expect an issuer to register a small securities offering in dozens of states. This is especially true given the lack of uniformity among states. However, states can play an important role in preventing fraud for offerings conducted in their jurisdiction. Regulators should consider moving beyond a binary approach to preemption. For example, when an offering is qualified in the state of a company's principal place of business, should that offering still be reviewed by multiple other states? Why should not a simple notice filing in other states be sufficient? Such a framework could promote more effective oversight among state regulators, reduce the time it takes to fully comply with offering regulations, and still maintain effective investor protection. Well, I look forward to reviewing the forum's policy recommendations and a readout of today's sessions. There are a number of other very, very important topics, which I know Chairman Atkins and Commissioner Peirce have already touched on. So I thank the team in our Office of the Advocate for Small Business Capital Formation, as well as in our operations group for helping plan today's event. I hope all of you enjoy the forum and the speakers assembled today. Thank you very much.
Thank you, Chairman Atkins, Commissioner Peirce, and Commissioner Ueda for your time here today and for identifying some of those important topics that we can consider during our discussions today. Turning to those discussions, I have a few housekeeping items. We have a great slate of panelists today. I'm very excited. Founders, investors, industry specialists, small public company executives, lawyers. We are very appreciative that they could join us here today to kind of share their stories and share their voices from around the country. But we're also looking forward to hearing from you, the public, folks who are actually on the ground navigating the small business landscape. So, a key element of the forum is the opportunity that it provides to you to participate in shaping policy recommendations that come to the Commission and to Congress, in ways that you can advise how to improve capital formation for small businesses and their investors. Many of you have already submitted policy recommendations, and for that I thank you. I know a lot of work and a lot of thought went into those. We greatly appreciate that. You can review, you can review the recommendations that we've received to date. They are in our recommendations portal. You can access that via a QR code that you can find in a couple of places. If you grab the agenda handout, it's on the back. There's also a poster with the QR codes out in the auditorium, outside the auditorium here in what we call Veterans Hall. If you're watching online, there's a link to the recommendations portal just below this video window on the event page, so you can check it out down there. We recognize that companies and their investors face different issues and different questions, have different needs at different phases of their life cycle. So we have structured the panels, as we've already heard a little bit, and we've grouped the recommendations into those three life cycle categories. So we have an early stage section, a growth stage section, and then the small cap public markets section. You can learn what recommendation topics will be found within, kind of considered falling within each life cycle stage. There's a table on the event page if you're watching me on sec.gov, or if you're here in the audience, again, there's some signage out in the Veterans Hall where you can kind of track where you might find what topics come up. We will also flash information about that on the screens here periodically throughout the day. So you'll get the QR code and the kind of what topics are which. Also on the another way that you can participate in today's discussions is that after each panel, we will have kind of a 10-minute-ish session for folks to step up to the mics you see here in the auditorium and share your thoughts on any of the recommendations. We would ask that the sort of mini sessions after each focused panel, if you want to comment, for example, on the early stage, you can pop up for the 10 minutes after the early stage panel and then share your thoughts on recommendations that are relevant to that life cycle. There'll be another opportunity to discuss growth stage, and then later you'll get an opportunity to discuss the kind of public company, small cap recommendations. We do ask that you limit your remarks to about a minute so that we can give as many people the opportunity to speak as we can. And then at the very end of the day, after we finish the small cap panel and that focused session on recommendations, we'll then have a full kind of open mic session in case you didn't get to weigh in on something earlier in the day. So once again, you can bring your thoughts and share them with the audience here. Then when we do wrap up the event, we will open up the voting. We ask that you hold your votes until the end of the event. Just in case things change throughout the day, we want to make sure you're weighing in on the latest and greatest. You'll be able to vote for up to 5 of the recommendations that you feel are most important or most impactful within each life cycle phase. And then we will send the top 5, after counting all the votes, we'll send the top 5 in each life cycle. Those will be reflected in the report that we deliver to Congress on today's Small Business Forum. And then if you have recommendations that you wanted to submit, but you maybe didn't get a chance to do it, I'll do you a solid. You still have a little bit of time. You can email them to us, excuse me, at smallbusiness@sec.gov. You can do that until about 3:35. It sounds very specific, but that's going to be the tail end of our networking break. So if you can get us get them to us before then, we will update that recommendations portal and share those with everyone to consider. So a lot of logistics to get out of the way, but I want to make sure you're all prepared to weigh in as many ways as you can. So with that, I will invite our first panel to come take their seats. And while they do that, I have a little pop quiz for the audience. Maybe just like a quick show of hands. I promise there was no homework. How many folks in the audience are founders or entrepreneurs? Okay, I see some hands popping up there. Great. How about investors? Do we have investors in the audience? Okay, a few more hands. Who here has raised or invested capital for a small business in the last 12 months? Okay. Hopefully we'll hear some stories today. And then finally, do we have anyone here who either works for or works with small cap companies going through registered offerings? Okay. All right, well, it looks like we have a good mix. I'm very much looking forward to the discussions. And with that, I will I'll introduce the moderator for our first panel and let her take it over. Today's first panel on funding for founders and empowering early stage entrepreneurs will be moderated by my colleague, Julie Zellman-Davis, also of the Office of the Advocate for Small Business Capital Formation. The floor is yours.
All right, thank you. Can everyone hear me okay? All right. Well, I'm super excited. The forum is one of my favorite events every year. I've been in this office since it was stood up in 2019, and this is always a highlight. And just a little bit of my background, prior to coming to the SEC in an old life, I practiced in big law in Boston and worked with early stage companies, mainly with private funding rounds and venture funds and some fund formation. So I love bringing all of that to my favorite event here. And with that, I'd love to just go down the line and have our panelists introduce themselves and tell a little bit like who you are and a little bit about what you do, just so folks understand what perspectives you're bringing.
Great, thank you. I'm happy to be here today. I hope you can hear me okay. My name is Sue Meekum. I'm the CEO and co-founder at Nala Membranes. Nala Membranes is an early stage company that's bringing some solutions to solve water scarcity issues around the world. So it's a big challenge that we've taken on. And I founded Nala because I wanted to do something important with my PhD in polymer chemistry. And so we founded Nala to develop new membranes to reduce the cost and complexity of water treatment and wastewater treatment. So I'll be talking more about that today. Thank you.
Thanks, Sue. I'm Mark Friedman. It's a real honor to be here today. In case you haven't noticed, this is geographically set up. This is the West Coast over here. This is the East Coast on this side. So I've worn many different hats through my career, starting off as an entrepreneur for most of it. And somehow I morphed into being an investor, an angel investor, which really I was talked into becoming because I wanted to be able to give back to some early stage companies that had difficulty raising funds. So I started off as an angel investor, formed a group called RTP Capital in North Carolina, the Research Triangle Park area of North Carolina. Recently become a professional investor with a group called Dental Innovation Alliance, which is a VC fund that we formed that works with early stage companies in the dental technology space. And finally, I'm a board member and part of the executive committee of the Angel Capital Association, which is the not-for-profit professional association of early stage investors.
Greetings, my name is Shane Moise, and I am from UC San Diego, where I run Horizon. It's our campus-wide accelerator and our kind of flagship accelerator there in San Diego. I work with around 1,700 different companies and researcher, scientific founders. So our view is agnostic. We're working with battery technologies, therapeutics, drugs, you name it. And so our effort is to try to make and enable those products getting out to market as fast and as effectively as possible.
Hi, everyone. My name is Sarah Hibbard. I'm also from San Diego. I'm an attorney at Snell & Wilmer, where I represent primarily startups, anything formation through exit. So I spend the majority of my days helping founders navigate the exact issues that we're here to talk about today.
Fantastic. Well, I'm very excited to hear all of the West Coast and East Coast perspectives that we have here with North Carolina and San Diego. But let's dive in. I'd love to hear, I loved our commissioners teed this up perfectly about hearing about the challenges and successes that folks are facing. And Sue, I'd love to start with you because when we spoke before, you mentioned that NALA from the very beginning, you've had more market demand than you've been able to meet. And yet, and this is similar for many deep tech companies, at every stage from proof of concept to manufacturing, there have been issues, you've had challenges getting funding. So I'd love for you to talk a little bit about that and just tell us some of the things that you've encountered.
Yeah, I'm happy to. So, at NALA we're a deep tech or a hard tech startup. When we founded NALA in 2018, we had a patent. And we had a great idea, and we had a problem to solve. So what the industry told us in water treatment, they said, chlorine-tolerant membranes are the holy grail. And what that means, to those who don't know, is the membranes that they've been using today are, not stable to bleach. They're hard to clean. They're easy to fail. And so these are much more durable, robust membranes. And that's what they need to reduce the cost and complexity of water treatment. So it's a big thing that we're trying to do. But we started with nothing. We just had an idea. And nobody's going to invest in an idea when there's no route to the solution at that stage. So we ended up with government grants. Government grants for technology and the SBIR programs through many of the government agencies support this type of early stage research that isn't, a product yet, but it could be something that's just groundbreaking for the world. And so that's really where we started. So government grants is really where we had to go to find money to start NALA. And so we were successful at being awarded grants through the National Science Foundation and through the Department of Energy. And in fact, over the years, we've managed to raise about $2 million in those non-dilutive government grants. But those grants, that's been over like a 6-year period. So that's not enough to fund, the development and scaling of a brand new technology. And so, we had to go out and raise investment, and we had to do it at a very early stage, which is very challenging for companies that have a very long path to market. And so, our government funding on our first SBIR grant, it ended, and we still obviously we'd only been around for a year, so we hadn't developed the technology to that stage yet, and there was a gap between the ability to be able to get more government funding. And so in order to keep going and developing this product, we had to raise equity investment, and we were able to do that through local angel funds in the Raleigh-Durham area. And in fact, Mark was one of my very first angel investors, and so that was that angel opportunity to work with angel investors to get some of that very basic capital to really build the technology from the ground up was really important. And we had to move on then to more, smaller VCs. And getting access to that capital has been a struggle all the way along, even though we've made steady progress towards the market and towards commercialization. And today we're raising money again. We're actually building our manufacturing plant. We've de-risked the manufacturing. We've shown we can produce these we will be able to produce these at scale once we get the equipment that we need. And that's where, we're struggling again to raise that investment, because investors, they don't like to put money into capital equipment. They would rather invest in software or AI or something. But to make a real hard product, you have to have a real machine. And those are the things that we need the investors to be able to support. And that's our challenge at every stage. There's a challenge, and that's the challenge today, is finding the right investors to invest in the capital that's required to produce this product that's going to change the way we treat water in this world and solve this problem for us.
Well, thank you for telling us a little more about that. And Shane, I'd love for you to take it from here, because you've dealt with companies like Sue's and others. What did you say, 1,700?
Yeah. We're tracking 1,700. But I think that the pathway that you've pursued and had success in with non-dilutive funding is essential, especially for some of our deep tech companies. I know that there is you can call it a rumor or kind of a mythology around, it's so much easier to scale things now with AI. But even creating products, if you can do it with some model, Gen 3 or whatever it be, that there's still going to be costs with that. If you run out of Google credits or Amazon Web Services credits, there is going to be a cost to develop and actually deploy these things to market, and in a meaningful way that's going to be customer driven. So I cannot stress enough the value of SBIR and STTR funding in helping to advance scientifically backed technologies to market. It is one of the most influential and kind of key milestone kind of indicators for a lot of the investors in our ecosystem. And I have heard, and some other folks here could likely chime in, though, that there is only a certain amount of non-dilutive funding that feels right. And so I think the challenge that you also identified is access to earlier stage angels and family offices, and then those maybe lower tier or smaller tier VCs is also key. I'm curious for your experience and what you two have also seen is, how geographically proximal are those investors? We are out in San Diego where, this much closer to Silicon Valley, and there is always this kind of push and pull of, well, we want founders to build where they're at. So if it's in North Carolina or in San Diego, not to get pulled where the money is. And so how to navigate that, I think, is very challenging for founders. That do we need to have two offices, one in Silicon Valley right next to the money and by our tier one investors? And so those are a lot of the conversations that we have in balancing those decisions. How are you building out a team, strategically placing and developing relationships with investors who are potentially invested geographically as well as in a portfolio of interest?
Sarah, what about you? What are you seeing from your clients in this space?
Yeah, I think it's a lot of what we've already heard, but also the compliance aspect and the corporate governance aspect. So obviously it is difficult to get the funding when you're in the position that Sue has just described, right? But then once you get that funding and now you're up to raise your next round, it becomes a question of, did you comply with all the securities laws? Did you comply with all the blue state filings? Did you do everything that you were supposed to? And when you're trying to build a business on such a small budget already, that question kind of gets left to the wayside until you get to a point where it becomes important. And we see this not just on the security side and the compliance side, but also on the corporate governance side, in making sure that these smaller investments have been properly documented and that we can kind of tie out and trace back that cap table. So these are all things that as you're building the business, you're aware of and you just don't have the time or the funds to focus on. Or maybe even you're not aware of, and now I'm in here telling you that you've forgotten to do all these things. And it is manageable once we get to that spot and these things are called out, but I think it is very difficult to get there when you're in the building stage.
Well, I'm going to use that as an excuse to put in a shameless plug for the resources that the SEC has put out on our website. And there were hard copies of a number of them at the front. When you come in and out, you can grab them. But they are there for free. They are not a substitute for a lawyer by any means, but they can help you at least get the lay of the land on some definitions. We've got a glossary that maybe talks about what is a cap table and what is non-dilutive funding and all these. You'll hear a lot of terms in the early days, some of which you'll know and some of which you probably won't. So just putting in a plug for that again. None of them are a substitute for a lawyer, but hopefully they at least maybe you can educate yourselves before you walk in the door and maybe reduce that initial bill. So, Mark, I'd like to move to you next because I feel like these challenges, and Sue already kind of teed it up by saying that, angel investment was key for her. But I'd love for you to talk about kind of your role as an angel in the Research Triangle area, which for those who don't know where that is, it's Raleigh, Durham, it's Chapel Hill, the third. Okay, part of the triangle. So maybe talk a little bit about angel investing in that area and then more broadly, but then I'd also love you to move us into the next conversation, which is about accredited investor definition.
Sure.
I know that's a key one.
Sure, glad to. I'd like to address a couple of the things that were said. The whole issue of having to redo cap tables and things like that takes me back to when I was in business school. We had a CEO from a grocery grocery store in North Carolina, a small town in North Carolina that was about to go public. They'd really expanded. And he was giving us a talk, and he said, we had our accountants come in, and they said, you've had all these shares from local people. You've sold stock to all these local people. You registered with the SEC, didn't you? And he looks at them and he says, why would I have to tell the Southeast Conference about this? That's a true story. It sat with me for many years. And, Shane brought up the issue of regional association. Another story, I remember many years ago, I ran a conference. It was called Financial Strategies for Successful Entrepreneurs. And we had a very well-known venture capitalist who was from Silicon Valley. And one of the attendees stood up and said, I've started a business in North Dakota, and nothing against North Dakota. But he said, we're seeing all of this success. Is this a place, a business that you would consider investing? And this is, many years ago, so it's changed a little bit. And the venture capitalist said, no, we wouldn't even look at you. And the CEO said, well, why? He said, we want scalable businesses, and we just don't believe you have enough people to make a business in that area that's going to be scalable enough for us. And you said you're not willing to relocate any of your operations. So there are issues with that. And when you get to the angel part of things, I could speak for RTP Angel Fund, but I also deal with a lot of different angel groups and a lot of venture capitalists. One of the primary differences, I think, between angel investors and venture capitalists are angel investors are typically more geographically located because a lot of the people that become angel investors want to give back to their community. They're all looking for great investments, but they also really want to be able to help those early stage companies. We're very fortunate in the Research Triangle Park area. We've got the 3 research universities, Duke, NC State, and UNC. And we put out a lot of different businesses that are really interesting. So when we're sitting there, we have an overflow of opportunities. We bring into the group for consideration maybe 20% of the companies we get applications from, and that's probably a high number, and invest in a far smaller number. And almost all of them are from the local area. So our rules, which are just our own rules, are we have 3 different areas we look at. One is the Research Triangle Park area. 2 is the greater North Carolina area. And I run a monthly call called the Triangle Angel Syndicate Zoom, which is just all the groups throughout North Carolina that get on. And our area is an extremely collaborative area, which you don't see in a lot of different parts of the country. A lot of places, they're competing for deals, so they're not really talking to other people about what the deal is. In our area, it's extremely collaborative, so we try to get all the different deals that people are looking at. Then you get on the venture side, and venture is geographically unbound most of the time. You do find some venture funds that have a geographic focus, but for the most part, it's unbound, and they'll be able to travel to see other companies. But one of the things we run into in our area is we get a lot of companies that get a term sheet from California, which are almost always significantly higher valuation than the east of the Mississippi term sheets. And we have to have conversations with CEOs fairly often saying, yeah, you could accept this term sheet, but they're going to want you to move to California. And have you looked at the differences in cost of living and things like that? And for some, it's great because they want the opportunities that can be provided out in the Bay Area or out in San Diego or whatever, but others don't really get that. So it's the old story of communication. You have to make sure people understand what it is they're looking at.
I'd love to take what you mentioned and ask about valuation, because I know this is an area where folks have a wide variety of approaches. So I don't know if y'all have thoughts on, when making that initial valuation. Shane, I know we've talked about this some, but just, kind of how to approach that.
So maybe just a reminder of reframing. So because I'm with the university, we are a step removed from, so we're not a part of the companies, but our job is to ensure sound structure, advice, mentors. In some cases, the first or second CEO after maybe a scientific founder. And so, when it comes to valuation, we do get these questions a fair amount. Someone says, well, I'm going to go out and raise $30 million. Oh, okay. Well, tell me more about that. Well, I had a meeting with Sam Altman, and he said, go for it. Okay, well, I can see where that amount comes from, but I think that with valuation there is not a set formula, and it's going to be variant and dependent on the technology, the experience of the team, and really the length of time it's going to take to get something to market. I have found in the last, I'd say probably year and a half or so, we've seen a lot more engagement with and experimentation with milestone driven. So we're going to raise 4 million, but it'll be 1 million in Q2 and 3, and then when we hit those, we'll open up. And so it's not the traditional sense of we'll raise a full round, and then we'll hit all our milestones in this amount of time. Investors are saying, well, let's leverage a small portion of what that round is to make something more meaningful happen. And so it's been an interesting kind of experience on the founder side, and I think depending on who you talk to and what day it is, you'll get a different number. So.
Yeah, I was just going to comment on that, and I think Julie has heard me give this talk before, but one thing too for all of the founders out there that are listening to this and you're new to raising capital is don't forget that pre-money valuation number is negotiable. I mean, it is something to think about, and going out the gate with a very high number might not be the greatest move, but also just accepting what an investor puts in front of you isn't necessarily the right move either. So it is something that there's a number of components that go into it, but it is also a point that's negotiated in the term sheets.
Thank you, I appreciate that. And I took us a little off track because I wanted to talk about the accredited investor definition. So I don't know if anyone has something they want to say on that front. I know, one of the things you've already touched on geographically, it's always an interesting discussion because, in lower cost of a living area, like Mark was saying, your pool of folks who meet those numerical thresholds of 200,000 for individuals or 300,000 if you're married, the pool may be smaller in certain, or definitely is smaller in rural areas than, say, your higher cost of living like New York or Boston. So curious, kind of if y'all have thoughts on that. And I know we've received a lot of recommendations on with accredited investors. So be thinking about this since you're going to vote later.
Yeah, I could give you a number of thoughts on it, and it's something that's very front of mind. One of the issues is that there was talk about indexing the accredited investor levels a couple of years ago, and there's still banter about that periodically. And the accredited investor rules were set very many years ago, and it was a fixed level, it was an arbitrary level at that point, and it really has never been indexed. But the world is different when they were first set. So there's a lot more venture capital out there today. Angel groups didn't exist. Things like the Angel Capital Association that gives protection and knowledge to people didn't exist. So today, most early stage investments that are done from private investors, not VCs, are done via angel groups. And they pool their resources, they do very thorough diligence. That didn't exist in 1982 when the regulations first came out. So it's a totally different world. And I think having rules that are just based on net worth are really not fair to a broad group of people. There should be a test for people. So if you think of the 25-year-old whiz kid that gets out of school, has gone to business school and understands investing and understands, more importantly, the domain that they might be investing in, and their best friend is creating a business and they're going out to raise capital, but this person doesn't reach $1 million of net worth yet, they can't invest in that business, even though they may completely understand what that business is and what the risks are involved. So you've got to have a secondary type of decision as to who should be accredited and who should be able to be investing. And the evolution of the accredited investor rules, or the genesis of them, was fraud protection. And back 40 years ago when they came out, there was a need for that. There still is obviously a need for that, but you have to be able to balance the fraud protection versus having people that should be able to make an investment and are being blocked because of arbitrary rules that are out there. So I think the moves that are in the INVEST Act and other things that the SEC and FINRA and everybody else has been looking at are really beneficial to making it a more level playing field.
I see other heads nodding here. We want to chime in?
Yeah, I'd like to. So in part of our engagement with you all, it's been to promote the information, the resources that are available, but then it's also about connecting with our investor ecosystem. And so one of our partners, Lucas Venture Group, said, very similar things. We want to, if there's a test or some other way that we can increase access for people to engage as investors, I'd say, there are many potential mechanisms for that to happen. But then the other group are also our faculty and scientists. So you talked about, a whiz kid, but there's also subject matter experts, people who are advancing and developing these technologies with their peers. that are often, without a mechanism to invest as well. So I think just saying, yes, it would be wonderful to see that advocacy continue. And that it is something, in terms of feedback from our ecosystem, that's really important.
Yeah, I was just going to add too that I think when you're looking at this in terms of geography too, I think it makes sense to expand that definition and to still protect investors, but also kind of put more people into that early stage investor pool, into that early stage friends and family round. Because one piece of advice that we give to founders is to go out there and network with investors before you need to ask for the money. And so if you're in a city or in a geographical area that doesn't have a lot of those opportunities to even meet those investors, let alone those investors aren't there, your best bet in raising that early stage funding and being able to put the company on the map for something that these VCs would be looking at, where you meet their income requirements or their thesis, or where you meet the level that they're looking for. If we can increase that geographical area and allow other investors to come in and get you to that point, I think that it would also be beneficial to early stage founders.
No, I really appreciate that. And I'm curious because, it sounds like there are areas where folks don't have access to as many accredited investors. We hear this a lot, actually. Curious what advice you give to companies that come in and say, I don't have a pre-existing network of accredited investors. And as a lawyer, my thoughts go to, well, there are other pathways. You could do regulation crowdfunding, or you could do intrastate. And I'm curious how you all view those and how the folks that you're working with view those or other options.
It's interesting. Crowdfunding has changed the playing field quite a bit. And there are a lot of misperceptions about crowdfunding. I could tell you very honestly, a lot of people look at companies that have gotten crowdfunding and think negatively about it. There's just this perception that you had to go to crowdfunding because you couldn't raise funds from traditional sources, which I don't believe is true. But it exists, and perception is so important with any of these things. So, Shane mentioned ecosystem. I think that's the biggest key to any of this, is the entire ecosystem, because the things that benefit the early stage companies, benefit the investors, benefit the economic development people in a region, and vice versa. And if you don't have this ecosystem working together and looking at the same type of end game, you're going to fail, because if one of those links fails, the whole chain breaks. And I think this whole notion of accredited investors is part of that. If you think, it's not just who could be an accredited investor, it's other things like who can attend a pitch presentation. I've had entrepreneurs that I've tried to coach in pitches, tell them to go watch other people pitch, and they say, well, I've been blocked from doing that because I'm not an accredited investor, I can't go in. I mean, those are just rules that need to be looked at, and the INVEST Act is part of that. And, for those of you that don't know, the INVEST Act is this series of different pieces of legislation that pass through the House. It's waiting for Senate approval, but I hear that there's a couple of things going on in Congress right now that might be slowing things down. So,
anyone else have thoughts they want to share on reg crowdfunding or other options for non-accredited investors?
Yeah, I was just going to say, I think there is a divergence that Mark has identified across the board of what people think about crowdfunding. And so I think my advice to founders when they come and ask, what can I do? Where else can I raise money? Is just be thoughtful about your approach to it. So one thing that we talked about on our prep call really was, I think, Mark, you brought this up, that a lot of these crowdfunding organizations will now do an SPV, and that is a great way to do crowdfunding rather than, raising $1 million and now having 1,500 people on your cap table. I think from my perspective, that's, the SPV is great. So I think it's just being thoughtful about the way in which you're doing it, and then also being able to justify why you chose that route when you're speaking with investors and they're asking about it. So
two other kind of, maybe not trends, but one a model and then one a trend. At UC San Diego, our office pursued a grant with the Economic Development Administration. We called the program the Venture Catalyst Program. And this was an effort to include pitch competition, preparation, coaching, mentorship, but then also kind of a full menu of capital options. So very often it's go raise money from VC or angel kind of funds, but that there are also small business loans. There are banking partnerships. And so there are lots of different types of capital that we found that we were there's this traditional narrative of go raise money, but we wanted to counter that intentionally by providing a more comprehensive set of resources and information to founders. Because not every company needs VC. And so different types of capital can be more appropriate for different types of companies. But then the trend piece, and this is something that I think we've talked a little bit about, is getting out of the geographic kind of bounds. And so, not just how are companies connecting potentially with the small business development corporations in your neighborhood and how are your companies coming to the West Coast, but there's a cancer diagnostic company that I'm working with called ALSOL, and they found a grant opportunity on the west coast of Italy. And so it's kind of like, okay, well, we can do EU clinical trial testing with this grant in another country that helps us hit our milestones for regulatory pathways here in the United States. So, I don't want to say, ship innovation abroad, because capital and access is here, but that we're finding that founders, of course, are finding really creative ways to hit the milestones that they need with capital that is friendly.
Yeah, you brought up, and Shane brought up before, the geographic issues. Shane's in San Diego. We're in Research Triangle. These are areas that are very, very big in early stage companies. There's a lot of parts of this country where entrepreneurs are starting businesses but don't have access to that. The SEC could play a great role in that. I remember meeting with the SEC the first time a couple of years ago, and I'd spent most of my career hoping the SEC never heard of me. But then I heard all these things that the SEC actually can do, and there really are a ton of resources that are out there that are available. So we just need to let the entrepreneurs know what these are and what they mean, because a lot of times they're young and they started a business, but they don't really understand all the nuances of things.
Well, I appreciate that free advertising. Well, I'd love to, one of our commissioners mentioned the finders issue, and I know we've gotten a lot of recommendations on this front as well. So this is, if they're so-called finders, it's not actually a defined term, but it's someone who's not registered as a broker-dealer, who's working to and offering to connect companies with potential investors. So I'd be curious if, to what extent you all are experiencing that in your line of work, and if you are experiencing it, maybe a couple examples of just in ways that you see it, and then how do you advise companies who, are wanting to stay in compliance with broker-dealer rules, et cetera, how you advise them on these fronts?
So I think I rarely see it, but I think when I do, it's a little bit hard to help startups navigate that situation, because sometimes it's not, it just doesn't feel right. Like what the finder is offering and in exchange for what they want just kind of doesn't sit right with kind of where the founder's going and where they want to take the company. And to me, I think it's something that they should all be very careful about using and about navigating how they're going to raise funding through that path. I so far haven't seen one that's been, I won't say that. There are a few out there that I think are doing well and are doing the right things, but I also think there are some bad actors within that group of people.
Yeah, I agree. I think there's a lot of confusion out there, and I'm not an expert on this. I looked into it. I've tried to figure out what can you do and what can't you do. Can you pay somebody based on how much they might raise for a company? Are you not allowed to do that? Do you have to be an RIA? There's this whole jumble of different things that you have to figure out, and it's very difficult. So from an entrepreneur's standpoint, it's almost impossible. So they have these different services that will send out emails for you, just blanket emails, which I think are generally pretty ineffective. And I actually worked with a company that was doing that, and I started getting emails that were almost identical to the emails they were sending out at RTP Angel Fund. And I could tell almost immediately which email service they were working with to get those out, because they all sounded the same. So some of them are really good, some of them are worthwhile. I don't mean to disparage an entire industry, but from an entrepreneur's point of view, I think they have to be really careful, understand what they can and can't do. And on a fundraising side, a fund side particularly, you've got 506B versus 506C, solicitation rules. They're all very complex and very easy to fall on the wrong side of what you should be doing.
Yeah, I can say as a founder, my phone is blowing up. I get calls, I get texts, I get emails. This is from people who, yeah, they're like, oh, we can help you. They're just throwing things at me, and it's it's clearly there's a lot of scammy stuff going on out there, and so it makes me just kind of, I'm not gonna deal with any of those. Like if I get a really good recommendation from an advisor that I trust, that might be somewhere I would go, but otherwise I stay far, far away from those types of opportunities.
I'd say there's, and this might be a bit of a gray area because I work on the accelerator side of things. And because I'm at a university, I have the benefits of an institution behind me and all kinds of different funding. But that for someone who's making a business model out of their accelerator, that there are questions or proposals usually, well, let me teach you some things. Let me teach you a business model and let me help you with your pitch deck, and then I'll take 3% of your company. And it's like, okay, so someone's asking for percentages of your company based on some educational material that they might have pulled from YouTube or from the SEC's website. And so we typically advise against that. We're not an accelerator, a university program that takes equity. Again, we're in a position that we're able to do that. But if there are a number of accelerators and incubators out there offering a service for percentages, and we have a kind of a not a great perception of it, because typically the results on the back end of that are, well, I didn't get introduced to anyone, or how do I pay for my new intern or this new dev person with coaching that I got? And so I think the tangible benefit is often not clear enough for us to endorse or to advocate a model for finding services, even as a part of some maybe more educationally tracked programs.
Julie, I've already given credit to the SEC, so I'll give credit to attorneys too. One of the things that we always advise early stage companies, and I've done this for years, is make sure you have an attorney that you're working with that knows this type of activity, early stage capital raising. This is the most expensive attorney you can get is the free attorney who happens to be a family member that's a divorce attorney and says, I can take care of your paperwork for you. They may be able to handle your divorce someday, but they really don't know what they're actually doing with all the nuances that go on with this and the advice as to who should be able to do things and making sure that you don't have people that shouldn't be on the cap table and all of those things. So, and some early stage lawyers will work for future equity. So it's really, really important if you're an early stage company to get good legal advice as you go along.
No, I appreciate that. I want to make sure that we have time for Q&A, so I'm going to ask one last thing, which is just to kind of wrap our discussion on geography, because I feel like there is such a great situation here. We did not plan it this way. It just worked out very conveniently to have two San Diego and two Research Triangle folks. But Sue, I'd love for you to just talk about your company that's stayed in North Carolina. Have you, there's a lot of data out there on, I think Chairman Atkins alluded to concentration of venture within a few, 10 companies. We also have data that shows, 56% of venture capital goes to 5 metro areas. But there are still hubs like RTP and San Diego and others where there is a vibrant ecosystem. But I'm curious, and trends have been changing a lot since COVID, I'd say, the data that we see of, folks get more comfortable on Zoom, but there's still some things that need to be in your area. So I just would love to hear kind of where you all are seeing, where is geography still very important? And, where is it that, like Shane's saying, some folks will say you need 2 offices, and in what areas is it less so? Where you don't feel any pressure anymore, or maybe you never did.
So I'm in North Carolina. We founded NALA in North Carolina, but actually I was thinking about founding a company before I moved to North Carolina. I came from a small town in Virginia, Blacksburg, Virginia, where Virginia Tech is. And that's actually where our technology came out of Virginia Tech. And we'd been thinking about starting a company, but I moved down to North Carolina. I moved down to the Triangle area to take a job at UNC, Chapel Hill. While I was working there, I explored the ecosystem for entrepreneurial support, and it was so great in the Triangle. Like, I was able to meet angel groups. I was able to meet, there's operations down there that are, they advise entrepreneurs, and they can introduce you to things. They have networking events. They have classes to help you learn about the types of things that you need to know to found a company, and the people that you need to meet. And I think that's, it's all that ecosystem is really important, not just the investors, but the ecosystem that the investors live in and around. And that whole system is really important, because that gives you the opportunity to network. And COVID taught us, Zoom is great, and you can do a lot of things virtually. Networking via video is not easy. I mean, we did some of it during COVID. It was challenging, but that really doesn't work that well. And it's really that, I think that's what's still possibly lacking in areas like RTP, is the ecosystem of those larger investors, those investors that are used to investing lots of money in great big ideas that can change the world. That those investors aren't everywhere, and you have to network with those investors. I mean, I go out to the Silicon Valley all the time. I have a son that lives there. Any chance I get to go to San Jose, I'm going. So I get out there as much as I can, but I'm not at those. I'm not at those events. I'm not glad handing with those people that have those big checks. And that's really maybe what's been such a challenge on the investment side, because I have the kind of company that requires that type of investment to really get us all the way across the line. This drip, 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 the way we've done it is much more challenging than some of these companies that can go out and raise $30 million right off the start, right? We've raised about 12 over about 8 years, and we've pushed it, and we're gonna make it. We're gonna do it. But it's gonna, it's been a much more challenging road than it could have been in a different ecosystem.
So I hate to cut this short, but I want to make sure that we get in any audience questions for our panel. And I think, as Amy described it, we're going to do maybe 10 minutes of Q&A for our panelists, so based on things they've said or questions you want to ask them. And then we'll move into more of the recommendations in this area. So on topics, you can look at what's been recommended and start talking about it. So Pablo from our office is here to help facilitate some of the Q&A. And y'all feel free to go on up to the mics.
Hello? Nope, still. Hello? Oh, there we go. All right. You guys have talked a lot about funding. I myself am very similar to you, Sue. My name is Sonia Gonzalez, and I'm the founder of Sadie's Manufacturing Group in West Virginia. I'm launching a patented dual-chamber pouch technology at the end of this month, applicable to infant formula, fitness, nutrition, and pharmaceutical markets globally. Funded by my own retirement savings, because no accessible funding pathways are designed for small regulated manufacturers like me. I have a research partner with Los Alamos National Laboratory and still can't access R&D tax credits. My technology ensures infants receive safe, clean water through formula. This product will save infant lives. 99% of U.S. manufacturers are small businesses employing 4.8 million Americans, yet every incentive is built for the 1% that are large. I'm not asking for new programs. What I'm asking for is extend what already exists. R&D credits, bonus depreciations, investor incentives to small regulated manufacturers building what this country says it needs. Incentivize it like you mean it. And so right now you guys have talked a lot about trying to get funding, but investors don't want to invest in us because we're capital heavy, and so there's no incentive for a investor to invest in us. If they did have some sort of incentive, then it's possible that we would be able to get these kinds of funding. Right now, I have to fund myself because there's just too big of a risk for me.
Say that, I mean, that hits personally. My partner's a lactation consultant, and so understanding and seeing the value of early nutrition for our most vulnerable, our children and infants, is tremendous. So I just want to applaud the effort that you're putting in to develop and get this to market. I don't have a good incentive solution. However, the things that we've talked about with regard to geography, and I think you said you're in
West Virginia.
West Virginia, that looking at centers of excellence. So at UCSD, there's the Human Milk Institute and a whole group that's looking at oligosaccharides that come out of that, and how do you derive and then create longer chain or longer tail therapeutics based on what we find. Centers for microbiome research, and how can you leverage those centers of influence and then geographically their networks into the funding that you're seeking and that you need. And I know, so you talked about just the incentives and the structure aren't there. And it comes down to that, I don't know if you'd call it like a truism or what, but it's about who you know. And
Yeah, well, I mean, there's these policies that can just be extended to organizations or manufacturers, small manufacturers, because all these incentives are for large manufacturers. So I'm not asking for new policy. I'm just asking for current policy to get extended to us, because we have no incentives at all. I'm creating R&D just like Sue is. She's got no incentives, none. And so, I mean, why not? Why can't we have these incentives? They're already in place. The bonus depreciation, if she buys equipment, if I buy equipment, we have to depreciate over 5-7 years. Why can't we have the full depreciation? I mean, we're a small business. A big business can have it. Why can't we have it? I mean, these are all things that are already in place. And especially the investor incentives. Those are the ones that are going to be the biggest to us. Why not incentivize the investors? Then they'll invest in us. Right now, they have no reason to invest in us. They get nothing out of it except total risk.
Yeah, I'm right there with you. I completely agree. Yeah, I mean, we have to, what we've invented and as part of our IP is really a manufacturing platform to reduce the cost of making membranes and to make it less environmentally impactful. I mean, we're doing big things here, and these are, we're going to be an American-made membrane company that's going to change the way the world treats water. But are we getting the support that big companies will get? I mean, those incentives that are there to support manufacturing growth, those are maybe going to the semiconductor manufacturers, maybe they're going to Samsung or even non-American companies, right? But they're not coming to these small businesses. So yeah, we're in the investor group that I speak to most of the time. They don't want to invest in capital equipment. They don't see that as a good investment. The banks won't loan us money to do it because we don't have the collateral for it. So there's really no assistance for small companies to do this.
Yeah. First, I'd say congratulations to what you're doing.
Thank you.
And raising funds is never fun, easy, or something you really want to do. You want to build a business.
You don't want to give part of it away at the very beginning of it either. So,
yep. So these obstacles are even harder when you're in a business that doesn't get the software funding or the AI funding or all the other big dollars that go out there. So good luck with what you're doing. It's hard, but as Sue found, there are ways to do it and stick to it. The other thing I would say is that you're hitting on an issue that I don't know who it is that can fix, but it's very broad, and that there's a lot of different entities that are involved with what you were talking about. You've got the IRS for tax credits, you've got FINRA, you've got SEC, you've got state regulations, and all those different things. So it's great being here at this SEC meeting today and talking about things that the SEC may be able to have input in, but we've got to be able to get you've got to be able to get all of that under one basket so people know where to turn, in my opinion.
Well, I appreciate you guys.
Thank you.
Hi everyone, can you hear me okay? My name is Usman, founder, CEO of Woody, a neobank platform. You talked about two very important points. You talked about, for lack of better term, predatory VCs, companies or accelerators that will just teach you 2-3 things, and in exchange they will ask for a chunk of your company. That's a permanent give, right? Now, as I do my research, I've noticed that there are a lot of rules that protect the investors, a lot of things that an investor can rely on when the deal goes bad. As far as a CEO and a founder is concerned, could you maybe help me learn about rules and regulations that would also protect founders? I want to take the example of the car business, used car business. There's something called fair market value of a car. You can't sell or buy a car too far away from the fair market value. But today, any investor can come and see a company that's worth $10 million and offer to buy shares at $2 million, maybe because the founder is in need. So what kind of rules and regulations do you think that founders can rely on to avoid that kind of predatory investment?
Well, I'll give the non-lawyer view of it. There are absolutely predatory investors that are out there, just like there are in any field. And one of the things I always talk to entrepreneurs about as they're raising money is that the first money that comes in may not be your best money to take. You need to be able to do some diligence on who those investors are. You know, when we formed our dental venture fund, the tagline we started using was Venture Capital Reimagined, because we had all come up through the industry. We weren't investors through, from when we got out of college. And we knew there were all kinds of things that could take place as you're raising money that are really distasteful. So the vast majority of investors, venture capitalists, private equity, angels, are really good people, and they're looking for investments that they want to be partners with these companies. But just like any industry, you're going to have the bad apples, and that's why the SEC makes regulations. That's why all the others make regulations. On the company side, I think it's just as important for you to do your diligence on the investors as it is for the investors to do the diligence on the companies. One of the other things I always recommend to an entrepreneur is talk to the other CEOs that are in an investment portfolio. So you'll get an unbiased view from entrepreneurs that are portfolio companies about what that investor is like. And that's one way to protect yourself.
Oh, okay. So I agree with, there is a certain time and a market. I think we talked about Adam Smith. And so essentially, the way that people are raising money, the same thing as you, has created this market for people to say, well, let me exchange. I've seen one example that was as high as 30% of a company that hadn't raised any money yet. And so this feedback, the conversations here made me think about, and I've probably got to give this a Google after the meeting, but looking at what it might be if there was an investor diligence checklist. So what are the criteria? If it's a Google search for who's in small claims court, there are, some things that we can do to be more, I'd say, systematic in what we're able to provide, from a non-legal standpoint. Here are some of the criteria that we think should be considered when you're looking to do business with an investor. So that was a great question and really good feedback.
Yeah, I think one of the other things that goes along with that, everybody struggles with non-disclosure agreements because entrepreneurs always want a non-disclosure agreement and investors never want to provide one. And there's a variety of reasons on both sides. So that's part of that. Know who your partner is going to be. Get comfortable with that partner because you want to have a long-term partnership. So there's all kinds of really important things that go along with that whole, in many ways, it's like dating. So just make sure you're getting with the right partner.
I want to jump in really quick. So we are happy to, I know there are 2 questions on this side, and we're happy to take those, but we should also be talking about recommendations at this time as well. So want to continue the conversation, but want to make sure that we talk about those policy recommendations. Again, it's on the agenda. If you click on the QR code, you can see the recommendations for each of the sessions. So take a look. If anyone wants to talk about one of these, several of them, feel free to come up to the mic at this time. You want to have the woman in the front row.
Sorry about that. I would like to go ahead and thank the lady ahead because my questions was a little bit about requirements and the challenges looking for funding. I'm and my company are in deep tech. We're infrastructure as a service, so anything that's 3D interactive from video games to digital twins to architecture. So my biggest question is that what recommendations do you have with the changes that have occurred over the last 10 to 12 years from regulations, restrictions to, removing the challenges? For those of us that are stuck in between incubator and go-to-market phase. Because just like regulations, investors have kind of changed their requirements as well.
I think this was in your all's report that, so one trend from last year was that capital has moved a lot later stage. So I think we I get emails, probably a dozen or so a week, if not every 2 or 3 days, of investors. We want to know what you've got. We want to know the earliest. Pre-incorporation is fine. But then those checks don't come until, the company's already got a product rolling out. So I found that more of our companies are forgoing the early capital raise and looking to leverage pilots if some companies can afford an unpaid or a cut rate or discount pilot to get the milestones and the data that they need. Because the feedback typically from our scientific founders when they go in and meet with investors is, we need more data, more patient data, more customers. A letter of intent or even a contract aren't enough. And I think that where the money ends up going is an indicator of that same trend. So that's not a solution, but I think just an acknowledgement. Yes. Mm-hmm.
I wanted to jump in on that too, because I have seen those goalposts move very, very recently. I've been talking to investors for years, and the trick is you've got to make relationships with these people, right? So you talk to them, and you might talk to them for years before they'll finally invest. And you have a good understanding of what are those milestones. What did they want to see from me? They wanted to see customer traction. That was super important. So I gave them, hey, these customers are interested. And they're like, no, we need to see some revenue. Oh, okay. So I came back to them this past year. All right, I've got $500,000 in revenue this year. Yeah, I've made that traction. We're ready to go for this round of investment. And they're like, yeah, maybe a little more traction. I mean literally. And you can't count on it when the goalposts are moving. It is a real problem.
Yeah. Yeah, one thing I would say is that investing is a team sport in many ways. And once you get one person, one fund, one group that's interested, very often you'll find others. And I can't tell you how many times I've heard from entrepreneurs. I talk to all these investors and they all have to write a bigger check, or we're looking for too much. And a lot of times you're getting responses that aren't really representative from the investors because they want to be nice to people. They don't want to say, no, we just don't believe in what you're doing. Some investors won't. Other investors will. So it's just get out there, plug along, talk to people who might be interested, because you're in a tough phase. It's easier when you're in the growth phase, easier when you're in the earliest stage, and you're also capital intensive. So good luck. I hope you find what that solution is.
Thank you, everyone. We have time for one more question before we have to move on to the next panel.
All right, thank you. Hi, y'all. Tish Scarborough, and I'm from North Carolina, so woo. okay? But I live here in DC. I am a founder. I'm ex-Microsoft, ex-Cisco Systems, but I built an AI-forward app called Affirmed. It's a workplace intelligence platform where individuals can essentially voice forward, so you can tell it about your workday, and it gives you actionable insights. And it helps you navigate the workplace, whether you're dealing with friction or wins, and it really helps you amplify it. And the second phase is building out the ecosystem to have lawyers, therapists, and coaches, because when you build your career, it's more about you than it is the role, and so it's infrastructure for you. But for founders that are building in the trust and workforce-centered world, I found it a bit challenging that investors aren't necessarily interested in that sort of market. So that's like my own personal barrier, but I would love to hear from you all. What sort of recommendations do you all have to help navigate that, and what sort of ecosystem can be built out for people that are building in that space? It's a space that I think is forthcoming, considering that there's a lot of things changing from like an employee perspective, contractor perspective, and people are really trying to figure out how do we maintain ourselves in the changing dynamics of the workforce. Thank you.
I could tell you the investing world has changed significantly because of AI. As an investor, you have to be able to, and this is regardless of whether you're angel, venture, whatever you might be, you have to be able to look past the technology and look to the entrepreneur in many ways, and make sure that entrepreneur understands what is that problem and why is it not going to be somebody else that has more money than I do, uses AI to generate a product that's going to swamp you. So that moat that you could develop by convincing people, whether it's customers, investors, whoever it might be, that you understand the market better than anybody, you're going to be able to react to the market better than anybody, and you're going to be able to position your product better than anybody, and understand the problem that needs to be solved. That's where you're going to have an advantage, because AI changes things. It's so easy for other people to develop things once somebody has an idea. You've got to show that vast and deep understanding of what you're doing.
I think I just want to mention one thing. I think too, there are other, so we've been talking a lot about VCs just kind of in general, right? And I think there are other ways to raise capital that are similar to VC financing, and even still VC financing, but finding the niche, finding that impact investor who's interested in the type of product that you're putting out. I think that's also a way to go about it, is finding, I don't think you're going to go to maybe the top 10 VCs in the country right now with your product, but if you find a smaller niche, a smaller ecosystem that supports that type of work, I think you would then maybe even find an investor in that realm too.
Thank you. I hate to cut off the conversation because the questions have been great. But I will invite our esteemed panelists to take a break, grab some water, make their way off the stage. Thank you for being here today. Thank you for the stories, the voices, the insights. It's been really, really great. At the same time, I will ask our second panelists to come grab their seats. John will help direct traffic and get those names swapped out for us. Again, sorry to cut short the questions and comments. It's been great to hear from the audience. It's been great to hear the stories, the founders, the challenges, and how it's aligning very much with what our panelists have shared with us today. So that's been really, really helpful, and please keep that feedback coming. There will be additional opportunities to weigh in, so if you really had something you wanted to share about some of the recommendations that we've either talked about or that we didn't touch on today, stay tuned, because we'll get that other opportunity at the end of the day to grab the mic again. So, all right, so as our panelists take their seats, I will welcome, we got them going? Okay. Anyway, our next panel, as we've heard today, is on growth stage companies and smaller funds, and will be moderated by my colleague Jay Krowitz from the SEC's Division of Investment Management. And I will pass the torch to Jay to introduce our panelists. Thank you.
Thanks. Hi, everyone. I'm Jacob Krowitz from the SEC's Division of Investment Management. I'm delighted to welcome you to today's panel, Investing in Innovation, Supporting Growth Stage Companies. Our discussion will explore how early-stage venture capital, small market BDCs, emerging fund managers, and thoughtful policy frameworks contribute to a healthy innovation ecosystem. We'll also discuss the practical realities founders and investors, from fundraising dynamics to secondaries to navigating exit opportunities. Without further delay, I'll have my panelists introduce themselves. Alyssa, why don't you start it off?
There we go. Hi, everybody. Alyssa Jaffe. I'm a general partner with a venture capital fund called Seven Wire Ventures. We invest in healthcare technology companies that help people to become better stewards of their health and really think about technologies and services meeting people where they are. I am operator turned investor, so I've been on both sides of the aisle, but for the last decade have been building and scaling in venture, particularly in healthcare technology. Glad to be here.
I'm Dwayne Hezak. I'm the CEO of two public companies. One is Main Street Capital Corporation. The other is MSC Income Fund. Both of these funds are actively focused on investing in smaller companies across the U.S. We do that in a couple of different ways, but the key for us is to be partnering with mature businesses across the U.S. economy and helping them deal with whatever their capital and financing needs are. I've been doing this for over 20 years, first as an active investor, and then for the last 7 years as CEO of Main Street Capital Corporation.
Good afternoon. I'm Holly Hiles-Pandel, and I'm the head of policy at CARTA. CARTA is a private market infrastructure company. We provide support for about 50,000 startups and 9,000 fund vehicles, really supporting every aspect of private capital management, equity management, valuation, and fund administration. So we really see that end-to-end ecosystem. We leverage this footprint on the policy side to try to serve as the connective tissue between policymakers and the private capital ecosystem, not only bringing insights back what's going on with the regulators and legislators in DC, but also how can we bring that information back to policymakers as well. Prior to joining CARTA 5 years ago, I had the pleasure of serving as the head of legislative and intergovernmental affairs here at the SEC under former Chairman Jay Clayton, and worked with Julie and Amy and Jenny, so it's great to be back. And I helped shape capital markets policy on the Hill before that, both at the House Financial Services Committee and for the now Chairman, Representative French Hill.
Hey everyone, I'm Jordan Walker, co-founder of Backtrack AI. And first things first, thank you everybody for taking the time out of your afternoon to be here. We really appreciate it. But Backtrack's an AI note-taking tool for live events, so trade shows, conferences, and everything in between. As far as my entrepreneurial journey goes, I've done many things since college, from starting a web design agency with my roommate, telling my parents I was going to drop out after a $500 check, and that I was officially had made it as an entrepreneur. And I've served on boards and volunteer in my community, every now and then. So thank you everyone for being here. We're going to have a good panel.
Thanks, everyone. Exciting panel. So let's just kick it off. We've heard earlier today about challenges entrepreneurs have securing funding that their companies need and the role that angel investors and other early stage investors play in helping them grow. Alyssa, Dwayne, you're both fund managers. Can you share a bit about your funds and the type of companies you seek to invest in? Alyssa, why don't we kick it off with you?
Sure. So, and thank you to the earlier panel. I think they made a lot of very astute points, particularly around the fact that this is often a marriage. So you really have to think about who you're picking, because I sit on boards for 7, 10 plus years with some of these companies. We invest, again, as I mentioned, all in healthcare companies. And these are really healthcare technology companies at the forefront to think about how we can transform for consumers, for everybody here in this room, the role that we play in our own healthcare. We do this in partnership with many of the incumbents, not in spite of them, but very much believe in sort of the end role of the consumer. We tend to, in terms of nomenclature, come in around this Series A. So I'm still earlier stage, but they usually have raised some prior capital, some angel funding, friends and family, some seed financing. And then we do have a growth fund that can continue to support companies as we grow and scale up. And so ultimately for us, it's really about, there's certain types of companies that are a good profile for venture-backed businesses. I think the earlier panel made a good point that not all financing should come from this type of entity, because there are expectations that are set when we look to make an investment and we look for the type of growth across these technology companies.
So in my case, as I said earlier, we have two public companies. We also have two private funds that we manage at Main Street. And we do a couple of different things across our strategies. One that I won't spend much time talking about today is that we are a lender to other private equity firms and their portfolio companies. There's a lot of people that do that, so I won't spend much time talking about that strategy. But our primary strategy and what makes us more different than other funds, in my opinion, is that we focus on investing alongside individual owner-operators. So we are typically the only institutional investor. We're investing alongside the primary owner, typically the founder. He or she has owned the business for decades, not years, and they get to the point where they're dealing with thoughts about retirement and succession planning, and they're not sure how to execute that strategy. So we'll come in as an institutional investor, come in with a very flexible solution. We can own as little or as much equity as they want us to, and then we'll provide debt capital to help them get liquidity for their initial transaction needs, but then also longer term be a value-added investor, both from a strategy standpoint, but also from an additional capital standpoint. Because we're public, through our two publicly traded funds, both of which operate as business development companies or BDCs, through that structure, we have permanent capital as the investment firm. So we take a long-term to permanent approach. We today are invested in 90 plus different companies across our lower middle market strategy. Some of those companies we've been invested in for longer than 20 years. So it's a intentional strategy we have that's afforded to us because of our public company and the permanent capital structure we have, that we then take and we try to work with the owner-operators and their management teams of our portfolio companies to maximize their opportunities, whatever that opportunity is. Every company is very, very different. Alyssa just said it, you want to make sure you're picking the right partner. In our case, part of what we do is give vast experiences across a wide range of companies. We are industry agnostic. We invest across a wide range of industries and companies. And then we take our permanent capital structure and try to provide what we think is the best fit for the needs and desires of the owner-operator and their management team and the companies that we invest in.
Thanks. And as like the resident 40 Act lawyer, I feel like I need to jump in here and just explain that business development companies, they're an investment vehicle that was created by Congress to help fund small and mid-sized businesses. And they raise capital, they use it to provide loans or equity financing, often to underserved, investors that are not necessarily covered by traditional banks. And in return, BDCs distribute most of their income back to their investors. So it's an interesting vehicle and one that in investment management, we spend a lot of time working with. So I was glad to have you on the panel to talk about this. We don't always hear from BDCs, so it makes me excited as a 40 Act nerd. All right. Well, Jordan, as a founder, why don't you tell us about your company's funding journey? And based on your experience, what advice you give to VC funding when you mentor others, especially in a smaller area like Jacksonville?
Yeah, absolutely. So in my company's history, we've raised from the earliest stages all the way up through Series A, and those are certainly different conversations that you have when you're speaking with all these different types of investors, I'm sure as everybody on this panel knows. As far as some of the advice that I would give to other folks when thinking about trying to raise funding and I think some of the questions even mentioned earlier, I think you have to put out way more volume than you'd expect when it comes to fundraising, right? I think I've talked to a lot of people and they go, yeah, I've had a few investor conversations and I'm getting discouraged, and my advice back is like, you need to have 10x the volume that, right? You need to be having hundreds of investor conversations. You need to be putting out as many shots on goal as possible. And then likewise, what I would also say is find creative ways to kind of cut through the noise, right? Like these investors are getting pitches all day long. And so one of the strategies that I deployed that worked really well for us is, well, let me just talk to people like they're a human, right? Like, let's talk about sports. Let's talk about football. Let's talk about basketball. Let's talk about the things that just humans kind of connect with, because they're getting so many pitches per day. I realized as somebody from Jacksonville with zero connections, zero ins into this world, I need to figure out, how do I relate to this person? How do I get them to become my friend in order to have these conversations and make this a productive fundraising conversation? So, yeah, lots of volume, lots of conversations about kind of personal topics at first, and then those transitioned into, hey, well, let's take a look at the business and see what you have going on. And I would say definitely in the early stages when we had nothing going for us and literally nobody knew who we were, that worked really, really well for us.
Great, thanks. All right, well, Holly, Carta works with the funds at a variety of stages. What challenges do smaller VC funds and emerging managers face compared to larger ones? And why is supporting smaller VC funds important?
So I'm going to take that in reverse. When you think about the importance of our emerging fund managers, private capital is what really drives innovation, job creation, economic growth in this country. If you look at, the rest of the world, the reason that America has been so successful is because of our capital market system, but in particular, this ability to provide patient risk-forward capital that helps democratize ingenuity. And one of the questions that we most often get from policymakers is, how do we recreate these, hubs like Silicon Valley? How do we do that in our backyard? In our response is, we firmly believe, like, it's the investor. You get the investor, the companies come to the investor, the companies attract employees, and you create this flywheel that helps ecosystems develop. Emerging managers are at the tip of the spear. They are more likely to invest locally. They're more likely to invest early on, and they're more likely to invest in a diverse pool of founders. And not only that, if you look at Carta's data, we actually show they drive better returns than some of their larger counterparts. But as you referenced in your question, they are under stress. Private capital is flowing, but it's not flowing broadly. I believe, Chairman Atkins referenced some stats where 40% of the capital is going to something like 10 companies. We're seeing like 75% of venture capital go to 30 VC funds. 70% is concentrated in 3 areas. So I think just access to capital is becoming probably one of the biggest issues that we're seeing, in addition to having fewer resources to deal with, the shifting regulatory environment, the policy environment, both, from the federal and what's going on in the states.
Thanks. Alyssa, I suspect you want to weigh in here, particularly someone who's not from the coast. I'd like to hear what you think.
Yeah, Holly makes some great points around just the importance of building innovation centers outside of Silicon Valley. And it's interesting because when I get asked this question, I live in the Midwest, my company, the customers of my companies do not live in Silicon Valley, right? They are headquartered in the Midwest. They are headquartered, Blue Cross Blue Shield of Florida is in Jacksonville, one of the largest, most innovative health plans out there. There are so many interesting and impactful large entities that startups are trying to access. And so when you bring capital to the non-Silicon Valley areas, you also help to facilitate those connections, which can be so impactful as well. I think for us, it's really, so 50% of our capital, so our limited partners, the folks that give us money so that we can invest, 50% comes from traditional financial sources, and 50% actually comes from these incumbents. It comes from the customers of our companies. These are health systems like Rush in Chicago, or Memorial Hermann in Texas, or Sanford in the Dakotas. It comes from insurance companies, health plans like Blue Cross Blue Shield or Cigna, from pharmaceutical companies, employers, again, really to create more of a cohesion around how we drive value. And so as we think about, being a non-mega fund, right, I get this question every day of how do we compete, how do we compare? It's really about in venture, it's not just picking great companies, but it's making and building great companies. Because especially, as you go up the value chain, it's a long game. We talk about being on these boards for a long time, the path just to get to the Series A, but from the Series A to exit is a very long path as well. And so creating these types of partnership opportunities is where we find value creation happens. And that's why, funds like ours have a lot of success.
Thanks. Now, Dwayne, we've been talking about startups a lot, but late-stage companies, they also continue to be steady workhorses for the economy. Can you just talk about some of the benefits of managing a BDC and the benefits to portfolio companies that receive BDC investments?
Sure. As Jay said, the smaller companies in the U.S. drive the vast majority of both jobs that exist and job growth, and that's something that we see across our portfolio. I think I said it earlier, we've been investing in this space for over 20 years, and one of the reasons that we found it attractive 20 years ago and continue to find it attractive today is that, one, the universe of investable companies is very, very large. There's a very diverse group of companies across every industry, every geography you can imagine that fits the profile of companies that we invest in. Just to kind of give that again, it's companies that are typically between $3 and $20 million of EBITDA or cash flow. So these are not startups; they're mature companies. They have significant employment, and they've been around typically for decades, not years. So when you look at our goal at Main Street and the purpose or the benefit we provide to the companies we invest in, most of those companies are owned by an individual. They're not owned by a fund, and that individual is going to reach the point in their life when they start looking at retirement. If they retire and they haven't planned well for that retirement, their company will likely not perform the same way it has for the decades prior to that event, and their employees and the jobs that are associated with that company will not have a good outcome. So our entire focus at Main Street is to provide a very unique solution to help those owner-operators plan well for retirement and succession planning. If they do that, they're talking to us when they're 50 or 55 instead of 75. But also, we come in and work with them as opposed to buying them out, work with them in a way that they get partial liquidity, but they and their management team maintain control. So the vast majority of what we're doing on our side is we're providing a combination of debt and equity, but it's minority equity. The ownership of the companies that we invest in is still owned by that individual owner-operator and their management team. We think that that's the most appropriate way for those businesses to be run. They know the business, their customers, their employees, their vendors much better than we could ever know them from Houston. So we think that ownership and the incentives that go along with ownership should be held by the people that operate that business on a day-to-day basis. So our goal is to first help that owner-operator deal with their retirement succession planning issues, but then longer term, after we've made our investment, find ways to provide value and create value for that team going forward. We can do that in a number of different ways. We're very active. We've got over 90 companies that we're invested in across every industry, every geography you can imagine. So we see a lot, we hear a lot, and we learn a lot across those activities. So we can take that expertise and share that with our portfolio companies. And then as our companies have needs in the future, whether it's needs for something that happened that's a good thing or an opportunity, or if something doesn't go as planned and they need capital to deal with those challenges, we're uniquely positioned to not only provide that initial capital, but continue to be their ongoing capital provider on both a debt and equity basis to fulfill whatever needs they have. Because no matter what you think is going to happen as you go out and you look at raising capital from an investor, whether it's early stage or if it's mature companies like we have, it's unlikely that things are going to go exactly as you planned. Things are going to either go a lot better or they're not going to go as well. So having a flexible capital provider like Main Street and one that has a permanent investment holding period provides a lot of flexibility and we think a lot of value to the companies that we invest in.
Thanks. All right, Jordan, as a resident founder, why don't you tell us about some of your experiences pitching smaller funds?
Yeah, there's certainly a difference between pitching pre-seed stage funds and larger funds. I can tell you those are way two different conversations. For us at the pre-seed stage, a lot of it was focused on us as the founders, right? So it's, hey, look, are these group of guys competent? Can they put together a business plan? Do they know their numbers? Do they have some sort of story here? Do they have some sort of metric that they can point to that indicates, hey, look, there's going to be success here? And I guess back to the previous question you asked, when I offer advice to other folks, what does that advice sort of look like? And what I would say is at the earliest of stages, I think long as you have something that points towards, hey, look, this is going to be a successful business, I think VCs can grab onto that, at least in my experience. So whether that's, in our case, we built up a wait list of 15,000 people and said, hey, look, there's 15,000 people that showed they want this. We can now use that as a proof point to go raise on. Well, I've talked to other folks who said, hey, look, maybe for us it's revenue. In this situation, maybe it's a case study or whatever the thing may be. But having some sort of metric that shows, hey, look, you can bet on us because we have industry know-how, we have the technical experience to make this happen. And then likewise, we can have it kind of in tandem, this metric, this wait list, these case studies, these customers, these revenue numbers, whatever that is, makes for a really, really good formula for somebody to be kind of successful in that way.
Great, thanks. So Holly, as our policy expert, I'm going to tap your knowledge a little bit. There are a couple of House and Senate bills going around, the INVEST Act, the Empowering Main Street Act. Can you just talk a little bit about these proposed policy changes and how they may impact capital?
Yeah, so one of the great areas in Washington that I think is being overshadowed with everything going on in the news and whatnot is probably the most consequential capital formation package since the Jobs Act in 2012. And importantly, it's bipartisan. All of these provisions that are moving forward is bipartisan. I am ashamed to admit I've been working on some of these policies for more than a decade now, and I started with Congressman Hill back in 2015, particularly the accredited investor provision that Mark referenced in the previous panel. But I'm probably more bullish now than ever that, with this bipartisan support, in fact, the capital access provisions got near unanimous support in the House, that we could actually see these move through the Senate and get over the finish line. But there's a couple in particular, kind of continuing on this theme of emerging managers, which I think will be most impactful. One is something called the DEAL Act, and this will expand the ability for venture capital funds to participate in fund-to-fund investments or making investments in other venture capital funds, and also to increase the ability for secondary investments. This is important for a couple of reasons. One, for the fund-to-fund investments, you can have an established fund, say in California, Silicon Valley, now invest in another emerging manager in, Nebraska or Arkansas, where I'm from, and help not only anchor that investment, help that fund build credibility and potentially attract other investors, but you're also helping distribute more capital across the country. The other piece with respect to secondaries, as we are seeing exits take longer and longer, this is actually an area where, the funds that are more, that have more resources, that can afford that, heightened regulatory regime that comes with being registered with the SEC, they're able to offer liquidity through secondaries. Funds that are ERAs are more limited to do so. Expanding this ability will not only help, unlock some of that capital, which will allow those earlier investors to recycle it back into the ecosystem. It also helps the employees of that company, access liquidity and make the value of their equity meaningful, which can provide, strategic advantages for maintaining talent. Another provision, which I know Commissioner Peirce mentioned in her opening remarks, is the expansion for the size and investor limits for the qualifying venture capital fund. Now, Congress created this subset of funds a couple of years ago with the goal of helping smaller funds raise money from a larger pool of investors and with a smaller check size. So again, those like lower cost of living areas, this could be particularly impactful. But the limits that were established at that time, we really haven't seen that utility play out, particularly when you look at the average seed round is now around $3 million. If your fund is capped at 10, now $12 million, and VCs make anywhere from 20 to 35 investments, you can't really build a competitive fund with that. So this provision would increase the number of investors to 500 and increase that fund AUM size to 50 million, helping those emerging managers raise capital from a broader pool of investors. And then again, the accredited investor changes that were talked about in the previous panel, this will allow, those local ecosystems, more LPs to participate and help, broaden that base to allow funds and companies to raise from more individuals.
Great, thanks. When we were preparing for the panel, Alyssa, you and I talked about secondaries and how you've had to deal with secondaries, and I think you've mentioned, your thoughts on one of these bills. I'd just love to hear what you have to think about that.
Yeah, no, Holly did such a nice job kind of outlining what's to come and some of this work. Maybe I'll make it real. This audience, I think, consists of investors, entrepreneurs, and I think generally folks who want to see our economy grow. And one of the biggest ways to do that is just the movement of capital. And so as we look at the markets and how the markets have changed so dramatically as we think about the size of private companies. The unicorns, the decacorns, those used to have, they IPO'd well before where they are now. And today they're sitting in privates. And not even just, as those companies get so large, but along the value chain, we start to think about there's now new channels to unlock more dollars. And so, we talk about the DEAL Act and what that means for secondaries. Well, secondaries is incredibly impactful whether you're an employee and you've been there for a long time and you want to get some liquidity, whether you're an emerging manager. And maybe you don't need that company. You don't need to stay along for the ride until they're a decacorn, right? You can get massive returns and sell that position to somebody else who is willing to stay for a long time. You can take that capital, you can reinvest it into other companies. And so as we just think about the ability in the secondaries market, even limited partners, we talk about a lot of those individuals who are now investing in funds. We have amazing individuals. Our CEOs who we backed are invested in our funds. Well, they also deserve and require liquidity. And sometimes venture capital funds, because of how long the private markets are holding companies, they are kind of full freight 15-year cycles. And, Dwayne talked about some of those folks as they prepare for retirement, that's a long time to wait to get some liquidity back. So I think what we really want, I think everyone wants in this room, is just creativity, right? Creativity and fluidity in sort of how capital flows. And then not as much restriction on who is able to invest and how many people can invest. Because I think the math that Holly outlined was right. Funding rounds are getting bigger. You have to have the capital to do it. And then if you're only going to restrict to a certain number of people in your funds, by nature, VCs then have to say, well, then I have to prioritize the biggest checks. And so that really, it should be the opposite. It should be, how can we democratize access to such a high value asset class with really phenomenal returns, and do it for more people who I think are looking to invest and have diversification in this country.
That's a good segue to our final topic, exit. Dwayne and Alyssa, from an investor standpoint, how do you think about exit opportunities for your portfolio investments?
Sure, I'll take that one first. I think, like any investor, one of the reasons you're in business is to have good outcomes, good results, and a good exit. In our case, I've said it a couple of times, being a publicly traded firm with permanent capital, it gives us a lot of flexibility. So when you look at the companies that we invest in and the individuals we partner with, as opposed to it being our timeline as the investor, it's their timeline. So for an exit to be attractive, it has to fit what they want to achieve, both in terms of the outcome, the financial results or the valuation, but also is it the right time? So having a permanent capital investor like Main Street, we believe gives our companies, and more importantly, the individuals that own and operate them, a lot of flexibility. And given the long-term to permanent approach that we take, if we and our partners have done a good job on succession planning, we can be the exit. So we have a number of situations where we have been working with the management team, first the original owner-operator and their team to get liquidity. Then over a 10, 15-year time period, if we've done a good job of hiring or promoting internally individuals that can become the CEO and the other members of senior management, once we feel like we've achieved our goals of achieving a really good succession planning and management team build out, then we, through the company or through Main Street, can provide that liquidity. So again, it's something that being a publicly traded firm with permanent capital gives us extreme flexibility. And not only flexibility that benefits us as the investor, but more importantly, or equally importantly, it benefits the company, the employees and the other stakeholders of that company, because they, again, continue to maintain control, not just control of day-to-day activities, but control of the strategic outcome and the long-term outcome for that company. So it's something that we utilize consistently, and we think is a key differentiator for us and the companies that we have the benefit or the opportunity to partner with.
And I think it's really interesting to hear both of our perspectives, but the thread that connects us is that there is a lot of creativity, and as we think about the exit path, we do still back businesses really in the hopes that they're going to have outsized exits. Again, this is a high-risk asset class, so we do aim for outsized returns, and that is the point. I give a lot of credit to the hardworking folks at the SEC, who I think are doing a lot of really interesting things to also try to pave the way for smoother paths to exit. The IPO markets have been more volatile, and so as we think about companies who are taking different paths, that's still something that is absolutely top of mind for them, but they have to think more realistically as well about other alternatives, because sometimes, like, for example, healthcare is a massive opportunity. We just crossed over 18% of GDP, and if the externalities of the public markets love the category, it's great. If not, it can be hard. And so we think a lot about M&A. Maybe you'll get acquired by a larger company. Maybe two companies will come together and make an even bigger business, and that business then can go public. Maybe there's more in the secondaries as we think about exiting in a different way. So the nice thing that's happening now is it used to be the path to go public and the path to do M&A were super different in terms of how you had to build a business. And today, those paths have really merged. Both require growth, but both require profitability. So companies are now actually taking advantage of saying, we're going to focus on building a great business, and we're going to focus on creating optionality for ourselves. And then we're going to look when the time is right, what is best for us and for our employees, for our investors, in order to have the best outcome.
Thanks. I just want to follow up on one point about IPOs. It's an area of concern from the commissioners, many in Congress, and just curious if anyone in the panel has thoughts about why companies may not be choosing that pathway as often as they used to.
Yeah, I can comment on it real quick. I mean, I think from our perspective, it seems to be that private markets may have better industry insight as to what the technology is or what the company is actually worth compared to maybe public markets, right? I think we see some insane acquisitions and valuations these days kind of in the private sector versus maybe public markets. Yeah, there's some outrageous IPOs and things like that, but I think people better understand and recognize, hey, look, people in the private markets better value my company and better understand what I'm trying to do here. And again, as Dwayne and Alyssa said, you're trying to get the best outcome possible for everybody involved, and so why wouldn't you go that route?
I would say maybe from my perspective, I mentioned we have two public companies. The most recent we took public just over a year ago. So for I think any company or investor, you're trying to weigh the benefits and the cost. Obviously, being a public company does come with costs. Some of those costs are just purely monetary costs, the cost of having accountants and attorneys and SEC filings every quarter, all the things that go along with being a public company. The other costs are the public visibility. You're on the clock every single quarter to post your results, and if you have a bad quarter, it can be pretty detrimental. So that's a cost of being public. So I think that each company, each investor group has to weigh those costs, and if you're going to go public, you have to have a view that that those costs are going to be well worth the investment relative to the benefit that you expect to have going forward. So I think it's just a simple cost benefit analysis, and anything that the SEC and the public company world can make those costs more efficient, more effective, the more success we'll have at having more public companies long term.
Yeah, I agree with everything that's been said. And there's not one factor, I think, that, goes into it. There's obviously a lot more private capital that exists in the market than, say, 20 years ago. So the companies that were forced to go public because they needed, access to greater pools of capital. You mentioned there's astronomical private company valuations now and huge mega funds and rounds being closed, so that now exist in the private markets. But I agree. I think that you may not want to pay for regulation, but that's something you can plan for and price out in cost. But it is that public markets reward predictable, repeatable results. If you're still building and there's some uncertainty, they're going to be hostile if you don't hit your mark. So I think that's the bigger issue. But one other thing, because we've had this conversation, obviously going through this process with the INVEST Act, because again, we want to see more companies go public. We want healthy private markets. We want healthy, vibrant public markets. But it is a lot more gray. It's not as black and white as it was, 20, 30 years ago as well. So I think we tend to kind of talk in these the way markets were, these old constructs, instead of kind of appreciating how the markets have evolved, particularly with the proliferation of secondaries in the private markets. And so thinking about, whether that's reimagining the public market disclosure regime, as I know that the commission is focused on now, but also thinking through kind of that, I'm going to say, intermediate or kind of quasi-public, where you have more of those secondary transactions, what that kind of reporting piece looks like as well. So it's more of a continuum, not just a public-private dichotomy.
All right, well, thanks. That was a really interesting discussion. Appreciate you all coming out here to help us out. At this point, we'll open up the panel to any audience questions, so feel free.
Yeah, as Jay said, we welcome everyone to come up, ask some questions to the panel.
Can you hear me? I think it's been great. Thank you so much. I'm Allie Hackett. I am here with my co-founder, Vivian Mays, from a company that we are founded. We took a lot of advice from the first panel and just didn't wait for full funding. We used friends and family, and we put a lot of wins on the board with paid pilots, and now we have some brand names, so it's really great. But I'm not going to ask the questions from that point of view. I'm asking from an investor, because I've also invested into VCs and into companies. My question is, as an investor, what rights do I have in terms of price discovery? I love Carta. Have been using it forever. I see all my losses and my wins on it. And there was one company where they offered liquidity, and it was 20% of your investment. And I actually elected it because it's 10 years. And so I elected to take it. And it was within 15% of where it actually trades on, different secondary platforms. Another company offered to buy back shares, but literally it was priced, and FMV was priced at $1.16 in December. When they called to offer back, to buy back shares, they were now on Carta at 55 cents. So in 3 months, how did that happen? And as an investor, of course, we said no. But what are my rights as an investor to see why it went from $1.16 to 55 cents?
So I don't have the answer to that particular question. What I will say, and what, this has obviously been a criticism of the private markets, that they're opaque, there's not as much information out there. But I do think, with technology, and again, your information is going to only be as good as your inputs. But as more people are getting access to these opportunities, we're using information and disclosures as, this is actually a wedge for companies if you're having that better investor reporting that's going out there. And I know, valuations have been all over the place over the past couple of years, and this is something that, I think we're seeing in particularly the exit environment now as being factoring into that. So I don't have a great answer as to.
It's really not Carter. Your job is just to report.
We just report
really
the information. Yeah, we're not.
I don't expect you to own that. I'm just asking the panel and the regulatory body, what are my rights to ask, how did that happen? How do you do that?
Sure. I'm not the regulatory body.
No, so, I know.
But I will give you, I think, first of all, it's amazing that you're both an entrepreneur and an investor. I think you're one of the most valuable people on the cap table for companies. I hope you know that. I hope you see that. For anyone in the room who's built a company, you become such a thought partner to management. And, one of the things to remember is when you are investing in the beginning, that's usually the most power that you hold in terms of what you're asking for. And so asking for things like information rights, it depends on your check size, it depends on who you're coming in alongside, but there are things that you can get, at the time of investment that's in the documents based on the number of shares that you hold, so that you are educated along the way about what's happening. On the flip side, I don't know about your specific case. Maybe you invested at preferred shares, then there was a financing, they went down to common, and that's where the pricing change happened. But I also, I'm a big proponent of our thesis in healthcare is what we call the informed, connected health consumer. So how do we give ourselves access to information, connect into the system to improve health outcomes? But this translates across everything. How do you become empowered, right, to do the best that you can do? And it's such a transformative time because of what's happening with AI tools, that you can use Claude or ChatGPT or Gemini, and you can say, what are the questions that I should be asking, right? There's a quarterly call for investors. I just got these statements, here are some things that I'm wondering about, and try to educate yourself, because it does get very complex, and many of us here are not lawyers. And so how do you take that information so when you come to the table to have a discussion with the person you have a relationship with, they're giving you the answers that you're looking for.
I was just going to add to Alyssa's point on that. Using ChatGPT as an example, you could build a custom GPT, feed it those documents, and then have it procure the information for you. when we're going through our handbooks or our investor documents or whatever, I built us a custom GPT that does exactly that. Rather than me trying to sift through, and I'm not a lawyer, right? Rather than me trying to sift through 80 different documents in all these different pages, it's, hey, feed it to the custom GPT, and then have it, give me the information that I'm looking for. So, yeah, just piggyback off what you said.
I'll just put in a quick plug. Last week, the Division of Investment Management held a roundtable on private asset retailization and valuation. You can find that on our website. Definitely worth taking a look at it. It's a 2-hour panel. Brought in a lot of experts on the valuation issue in particular.
Hello? Oh, perfect. Hi, I just wanted to say thank you to the SEC for doing this. This is so valuable. And to the panel. I have a specific question for Alyssa. My name is Christiana Russell. I'm with UCSD. I'm a federal grant writer, and oftentimes I am more focused on early stage, but I do work with growth stage. I have a question about what would you advise an ESO like ours to ready companies for that growth stage? What specifically do you look for?
Yes, well, thank you for being here. I love people like you because you are the ones who give companies non-dilutive financing to drive innovation, to build a company that then I come and invest in. So part of it, I would say, first is awareness. There's so much capital that's actually available that is, again, non-dilutive. I assume that, but maybe you have a fund or your structures. Sometimes they come in pairs that, universities will say, hey, we're going to give you this grant, but we're also going to invest alongside, which is incredible. It's an incredible way to start a business. It creates a great reputation for the university, and it builds kind of a ground floor for entrepreneurs. And so I think a lot of people aren't aware. So if the question is, let's start there of how do they know that capital like that exists? And then once they've come to you, we sit, I live in Chicago, we sit on the University of Chicago. Yay, great city. 65 degrees today, so just everyone knows.
I know.
And so, University of Chicago, Northwestern, there's some incredible universities where we actually give sort of philanthropic time where we will judge pitch competitions or give advice. The biggest probably gap that I see is some of those companies have unbelievable ideas or technologies, but don't always think about the application for, how that is a company, right? And often in venture we say, like, is this a product? Is this a company, right? Is this a technology? Is this a company? And so empowering them with that language, finding people like me to do pitch practice just to get comfortable with the vocabulary that people like me are going to ask and the types of questions, again, using AI to practice too. I mean, this is like a whole new world has opened, but that tends to bridge the gap. But some of the best companies in the world were started because of people like you. So I'm a big fan.
Perfect. Thank you.
Thank you.
Awesome. We're still taking questions, but just a reminder, if you want to talk about any policy recommendations for growth stage and funds, we'd love to hear them now.
Hi, me again, Usman Konde, founder and CEO of Woody, a global neobanking platform. What's your take on corporate VC? We are facing a stage where funds, there's a lot of money going to corporations because of automated workforce. And are there any regulations or any recommendations that we can, or that you could provide to the SEC to incentivize these corporations to invest more in companies? I take an example in my company. We didn't raise funds from traditional VCs, but we have amazing corporate VCs behind us. And we would like to see that happening more because corporate VCs are really coming in as partners, and most of the time, these are non-dilutive investments, so it's a win-win for everybody. So maybe you have some recommendations or suggestions along those lines?
Well, I'll let you chime in on policy. I would say your story is one that I hear a lot, and we are big proponents of this type of capital because it is typically different capital than traditional sources. So it's not subtractive, it's really additive. And the earlier panel talking about manufacturing, and there are also corporates who invest there. We invest with many corporates who have a keen interest in healthcare. And they often are the customers of the company. So it creates aligned incentive to say, we're not just going to give you capital, but we're going to partner with you commercially to help you grow, and then your business is going to be even more successful so you can raise more capital. It creates a great cycle. I think a lot of it is just information asymmetry, that it often stems from corporates having a really innovative person who spearheads. Some of the very big ones have more traditional fund structures at this point, but for the most part, it's somebody coming in and saying, this is something we need to do, and they invest off balance sheet. And I would love to see more of an acceleration and tailwinds for them to create fund structures where that, if that person leaves or retires or things change, that it goes beyond them and it really becomes institutionalized, because it's such an impressive source of capital for many entrepreneurs.
Yeah, I can comment on that too real quick. So Salesforce Ventures, for example, is on our cap table. And to your point, Alyssa, having them commercially aligned with us is a really, really great thing to have, just very honestly speaking, right? But what I would say there is typically everything Alyssa just said is kind of how we kind of came into being with them and what we see, which is usually there's 1 to 3 people that were like really, really excited about it, and then the rest kind of just functions like a traditional corporate sort of business. So I'd say spend a lot of time getting really comfortable with those folks and telling them like, hey, here's why we're the next really big opportunity, and then making sure the other folks kind of around them understand that as well, because in my experience, those other folks aren't traditional VC people. They're more just, hey, I'm a person who has a job at Salesforce and like I'm assigned to this team, but I don't really kind of understand it. So making sure they're very, very aligned with what you have going on and understand like the language of fundraising, of what venture actually looks like, what a startup actually looks like, and what that means going forward. So food for thought there as well.
Hi, I'm Giri Srinivasan. I am the CEO and co-founder of a company called InfraClear. I wanted to make a suggestion sort of based on the previous panel and this panel. One was, I think we all know that for founders, you sort of navigate your way through various securities rules as you're starting out, and you learn from a good lawyer, and sometimes you learn too late, or you spend a lot of time going and fixing mistakes early on. IRS has Free File. I was wondering whether there's something that the SEC could create along with the IRS to be able to go and help navigate the series of forms that you would need to be in compliance, whether that's an 83B or whether that's thinking about QSBS, whatever else it may be. Having some form like that or a series of steps, I think, would help a lot of founders who don't have those budgets early on to be able to go hire expensive counsel. We've raised about $7 million in seed funding over time. I used to be an investment banker, so we sort of knew a bunch of these things going on early on. So, but I think that would be helpful. The second thing is on a couple questions have come up about evaluating funds. And I wonder whether, while mutual funds have a ton of disclosure requirements, venture capital funds and private funds don't have the same disclosure requirements around performance. And so while that would sort of throw the cat among the pigeons, I think being able to have a consistent format for just what that fund has done overall over time, tracking beneficial ownership, all the way up to the LPs. You sort of worry if you're going to end up being a government contractor as to whether you might end up, there's foreign influence control issues you need to worry about also. So I think there's a number of things that founders find out through accident or anecdote that if the SEC mandated certain disclosure rules for funds consistently, it would help everyone stay in compliance.
Thank you. I'll let Jenny give a quick plug for the Small Business Advocates Office website, because I think a lot of the information you're looking for is there.
Always happy to give a plug to our resources. We have resources on, as Julie mentioned in the first panel, on kind of the early stage resources talking about what is an accredited investor, what is the SEC, going to Mark's point on the Southeastern Conference. And so all sorts of resources, so just starting out, but also in the fund space, we have 2 different fund building blocks that I would highly recommend you check out. And it talks about kind of the regulatory structure on looking at the investment company Company Act, the Investment Advisors Act, and then the capital raise under the Securities Act, as well as kind of other considerations when you're looking at a fund. Also, the glossary. I mean, it breaks down everything kind of from your basic capital raising jargon to like what you need to be thinking about when you're talking to an angel or a VC, as well as kind of when you start looking at potentially going public and what is the public markets, and that we'll get to in our third panel. But yes, love the resources plug. There's also a lot, we've talked a lot about data in the panels. There's a ton of data in our office's annual report. I encourage you to go look at it. It really does kind of help reiterate many of these same themes that we've heard today. So really, this has been such an excellent discussion. Thank you so much. I'll turn it over to Shane.
Hi, Shane Moise from UC San Diego. So I actually have two questions, and so a bit of policy as well. For when you're soliciting for funds, do you or have you found, let's see what my notes here, that the rules around solicitation, have they been enabling or are they burdensome, or has that been an issue? And is there a policy or some new way of doing that that might make that easier? And then, of course, there's a part two. That if you're looking at different scales or how much you're looking to distribute or invest, could the requirements for reporting be different for the different stages at which you're investing? And would that make a difference?
So I can take the first part around the solicitation piece. You know, in the Jobs Act, Congress did create a new provision that would allow you to fundraise, to broadly solicit, to advertise your fundraise, but you had to take, quote, reasonable steps to verify whether or not it was an accredited investor. And just, you know, based on a lot of the data that we've seen, there hasn't been, I think, as much pickup in that space as, you know, we had expected to see, and I think some of that, you know, a lot of it was around, you know, the potential, you know, loss of exemption, or if you didn't like follow the steps, you know, just right, that, you know, it wasn't necessarily like worth the risk. I do think, you know, I know the commission last year put out some additional guidance to try to provide more clarity around that. I know there was rulemaking and back in 2020 to help, you know, kind of ease some of that burden. But I do think that is, you know, one of the things candidly that we've seen a lot of is it is, you know, not just like a geographic like concentration, but it is being part of that club. And I think, you know, I think there was a study a couple of years ago that it was like if you move to Silicon Valley, you're, you know, almost 200% more likely to get VC funding. So it is like being in those networks. So I completely agree. We should think about how to be able to solicit more broadly.
Thank you.
Yeah, there's probably more that can be done both on the education side and on the policy side. Funds that are forming today are probably doing a better job, purpose-built to understand. And, you know, for us, we were not purpose-built that way. We were prior to some of the changes. And so this is, while entrepreneurship is ask for forgiveness, not permission, this is the opposite. So I think, though, as so much of our world moves digitally, and it's, again, you know, huge plug for the SEC. Obviously, all of you are here and took time out of your day to come in person, but just, you know, broadcasting this, making this available, the amount of people that will have access to this discussion versus previously not being able to is so impactful. The lines continue to be blurred. So as a fund manager, you know, we're always looking for ways to be educated because we do spend a lot of, you know, our brand, and again, not one of the biggest things not being on the coast is having a brand that can scale nationally or even internationally, depending on your focus areas. And a lot of that comes with, you know, potentially what could be perceived as solicitation. I think the second question, I'm not sure if that was for in venture concentrations or.
Yeah. Yes. In venture.
You know, that we, you know, I guess we haven't found that to be as much of a hardship on some of the limitations we've had. You know, we had a very large company that we started and sold for $18 billion. called Livongo, is focused in chronic condition management. It started in the diabetes space. Because of fund concentration limits, we had pro rata, we had 2 board seats, and we weren't able to, continue to fill it. There are other ways to solve. We ended up raising a growth and opportunity fund that vehicle's specific purpose is to continue to support. But, in that case, it would have been helpful to have, less of a restriction. So for some of the breakout winners, but at the same time, I recognize why there's always a balance, because while you want to maintain some concentration, you also need diversification, because, we can't always predict the future as much as we try.
Thank you.
Thanks. I think we're coming up on time, but thank you to the panel. That was great conversation, and always appreciate the shout out so that we can share our resources and data. It's what we can do to help build the ecosystem on our end. So we are now, we can start moving our way to a well-earned break, but please continue the conversation out in the hall. I love to hear it going. And I will remind everybody that the cutoff for submitting recommendations is the end of this networking break. So I've got 3:25 now. Let's reconvene at 3:40, take about 15 minutes. And again, get any of those last-minute recommendations in. You can email them to smallbusiness@sec.gov. And we'll see you in a little bit. Thank you.